Excellent. Investing in mutual funds, bonds, sukuk, and other fixed income instruments. So you need to understand how the world works. The world economy runs on debt, you know. And I remember having this conversation with somebody, and the person was like, I had put out an article that centered on why should government borrow after they keep declaring that you've made a lot of money from IGR. IGR is internally generated revenue or internal generated revenue. So most countries of the world would have one way or the other that they generate money, whether from taxes, from custom duties, excise duties, rates, levies, and all of those, or from provision of services that they get money from, right? So if you go to a government hospital and you have to make payments, not the NHS style that you guys have in the UK. In Nigeria, if you go to a public hospital, you may have to make some sort of payment. It may not be as much as when you visit a private hospital, right? So all those revenue is what makes up a country internally generated revenue. The argument is if you make so much from revenue, why should you still go ahead and take loan to finance some of your projects? And the answer to that is that the way the economy of the world works, there are a lot of capital projects or a lot of projects that you may want to do as a nation or an economy that you don't have the resources to do it. And if you say that you should wait until you have enough money before you do those things that can unlock growth, then you may not be running an economy. And the way I would explain that is from a personal finance point of view. Let's assume that you are a fashion designer, and some of you that have followed me, you probably have seen that post. You're a fashion designer right now, and you need a machine, let's say an embroidery machine. That machine will cost you 500,000 naira to buy. You don't have that money. The options you have is to wait, start saving. Let's say you can afford to set aside 50K on a monthly basis. So your option one is save 50K every month for the next 10 months. By 10 months, you have 500K. You can now go and buy that machine. But you also have to be prayerful that the cost of that machine would have gone up because of inflation. That's option one. Option two is for you to approach a bank. You already can afford to pay 50,000 naira monthly from your cash flow. Approach a bank, get a 500K loan at 20% interest or 30% interest, buy the machine, continue to make the payments from the cash flow that you are getting, and that machine, you start using it from the next month because you approach the bank this month, they give you the facility, you're able to buy the machine. From next month, you put that machine into operations. It means that within 9 months, you can make a sizable amount of money from using that equipment or that machine that you didn't have up until that time. So that's the way to think about debt. Debt is often a leverage. So I just painted a picture of two people, one person that took the loan and the other person that decides to wait till he can afford it. So if you look at the other person that is waiting till he can afford it, he's probably losing out on some opportunities. The revenue that he could have made in those 9 months of having that equipment, he's losing out on it. So that's the concept of opportunity cost, right? For every decision that you make, there's an opportunity cost that is attached to it, meaning the alternative that you forgo for that opportunity, for that in that equation. Let me bring that back analogy into government. So government wants to construct a road, right? It will cost them like 50 billion to construct that road. And I want us to at least take the spotlight off of Nigerian government. Now, just think about government globally because this is a global class. Whatever principle I'm teaching is applicable to all countries of the world. So don't think in terms of Nigeria alone because we may start thinking that Nigeria, they are thieves. The government is not doing their work and all of that. But just think about it from a macroeconomic view, meaning we are talking about the world, right? So the government wants to construct a road and they need 50 billion to construct their road. Their internally generated revenue for every year, let's assume that what they generate every year in the whole of the economy is 10 billion, and they need 50 billion to construct that road. So the option they have is to wait for 5 years before they can do that road, meaning they save 10 billion every year for 5 years before they can do that road. So think about the limitations that most governments of the world would have. First off, in a country like Nigeria or the US, where a typical political era is 4 years, right? So it's taking 5 years to save money to construct the road, and your administration is only 4 years. It doesn't make any sense. So that's one disadvantage. The other disadvantage is if you construct that road right now, if you take a loan of 50 billion to construct that road, you are likely to unlock other investment opportunity. What does that mean? It means that if you construct the roads today, right, more companies can say, oh, we wanted to establish a factory in that location, but we're unable to do that because there are no roads. Now that you have constructed a road, it's an incentive or it's a motivation for them to now go into that space and open up their factories. Once they open up factories, how does it now cascade into the entire economy? When they open up additional factories into those or in those remote locations, by virtue of the road that you have constructed as a government, they hire more people in that economy, means that we can reduce unemployment. When that is done, as those people are hired, they get paid salaries. When they get their salaries, they pay taxes to the government. So you can see that everything in the economy does not work in silos. Everything works, it's more like a cycle. One thing affects the others. So that is why a lot of times you see government going for loans to do critical projects. Of course, when we come back home, what is our challenge here? The challenge here is really transparency. You take the loan, and let's say you want to construct a road that is 50 billion. You get a loan of 50 billion. Do you really use the 50 billion to construct that road? We cannot begin to put our Nigerian arts on right now and say, okay, you've taken 50 billion for this road, but by the time we look at it, the integrity, if we do an integrity test on that road, we now see that no, they have only spent 10 billion and pocketed 40 billion. That is what is happening in our case, right? It's not so much about the debt because it's a normal economy index or a normal economic step for governments to borrow money, right? To unlock development in their economy. So someone had argued with me and said, oh, countries like Algeria didn't borrow. And then I said, no, there is no country in the world right now that is not borrowing. Now, there are different kinds of borrowing. There is the internal borrowing and there is the external borrowing. The internal borrowing is the one that they borrow from citizens, which is what we're going to focus on today, right? Governments can borrow money from you, but they can also borrow externally when they borrow from IMF, from World Bank, from China, from all these other advanced economies. They can borrow money from them. So then I said Algeria. I said it's just a function of putting it on Google. Yes, Algeria, we know that the current government in Algeria is practicing what is called a measure to reduce the debt of the government. So they said instead of borrowing for critical projects, can we look inward first? How can we cut our costs? Which I think we should also adopt in Nigeria, cutting significant portion of our costs. They cut the salaries of people in government, all the wasteful spending that has been done in the economy. They started cutting down everything. That way they had more money, but it wasn't still sufficient for the level of development that they want. So what they now did is, after they've done that first layer, they now went on to borrow. So they still borrowed, I think, $20 billion from the World Bank. So every country borrow. It's a normal thing in the economy. Right. So let's go to the capital markets. When governments want to borrow, how do they borrow? And I've said that they borrow from international sources. We call that foreign debt, and they have domestic debt. Domestic debt is the one that they borrow from within the country, either from individuals or from institutions in that country. So when they want to borrow, the vehicle that is used is called capital market. The capital market is like every other market. If you go to Lagos market, Balogun market to buy lace fabric, or you go to what's that one? Asfamda market to buy engine oil, or you go to Alaba market to buy electronics. Just the way we have this normal market, we also have the capital market. Capital market is the financial market or the financial hub of the economy. That is where a lot of financial instruments are bought and sold. So the capital market operates in two ways. You have the primary market and the secondary market. Or you can say it that this way, that the capital market is divided into two components, the primary market and the secondary market. The primary market is a place where primary market dealers operate. And I'm going to try to explain that very well so you can understand. I'll also use some analogy that I think we may be familiar with in our day-to-day transaction. If you want to have your wedding today as a Nigerian, and you need like 100 crates of Coca-Cola for the wedding, it's unlikely that you go to Nigerian bottling company. Nigerian bottling company factory is in Ido or Ikeja, just I think as around ShopRite in Ikeja. It's unlikely that you go there to buy 100 crates of Coca-Cola. Even if you go there, they would not sell to you. They simply tell you that we have distributors. If they are selling to you directly, they are violating their distributorship framework. How will I put it now? They set up a framework, or they have a framework in place, which is we produce, we sell to distributors, distributors sell to wholesalers, wholesalers sell to retailers, and retailers to consumers. So it's a flow. If they now start selling to you directly, they are breaching a fundamental or a standard that they have set up by themselves. So they will tell you to go to distributors. The distributors in that example are the dealers of the primary market. When you are buying something from the primary market, you are buying directly from the people who issued that instrument. So in the case of financial products, if you buy at IPO is initial public offering. Last time I told us to buy Sterling Financial Capital stocks at PO. That one is not IPO, that one is PO, public offer or public offering. We have IPOs, which is initial public offerings, and POs, which is public offering or public offers. So if a company is coming out for the first time to raise money from the public, that is when they do IPO. That's why it's called initial public offering. The first time they are ever going to do that. MTN came to raise money from the public for the first time, I think in the year 2021. I'm not sure now. That was when they came to the market for the first time to raise money from members of the public. Essentially, when companies start as private, most companies will start as private companies. It's just one person or a group of people that have started it. And after a while, they want to grow the business. Maybe they want to open several branches across the country, or they want to go international, but they don't have the resources to do that. They can take the company public, essentially open it up for other people to become co-owners of that company. So when they sell shares themselves for the first time, it's called initial public offering. But there are times that they need to raise additional capital, such as what is happening within the Nigerian banking sector right now, where all banks are trying to raise their capital. The central bank has given all banks in Nigeria a deadline. The deadline is March 30th, 2026. And it is for them to raise their capital base. Let me backtrack. Where did this start from? The government said they want to make the Nigerian economy a $1 trillion economy by 2030 or 2035. I'm not sure about the year right now. So to support an economy that is $1 trillion, the strength of our banks currently cannot carry that weight. So they've told them that we want to develop a $1 trillion economy You are a key player. Banks are a very key players or a key player in any economy. You cannot grow any economy without the banks. Matter of fact, if you read and study macroeconomics well, you see that a lot of things that the central bank does in terms of monetary policies, they do them through the bank. A very good example. One of the duties of central bank is to control inflation. Inflation is when price of goods and essential services are on the rise, or when there is excess supply of money. Those are the two things that causes inflation: excess supply of money into the economy. I asked a question in one of my posts. Why is it that the government cannot, central bank cannot just print a lot of money and give all of us money? Why can't they do that? Because they can actually do it. But why wouldn't they do that? Because when they start printing money in excess, it results into inflation, and the value of the currency begins to drop faster. Let me give you an example. So if they print like a lot of money and they give all Nigerians 50 million, the day they do that, I can guarantee you that the next day, the prices of things will rise. Conductor will be calling Aja from Lekki, and he will be telling you, enter with your 1 million naira change. Why? Because we're all millionaires now. What makes money important is because of scarcity. So anything that is scarce is important. When you now make something that is scarce not scarce, you will cause inflation because everybody now has it. It's no longer a big deal. Matter of fact, it will also affect the productivity of that economy, meaning that and I have 50 million in my account and I'm a driver, and you tell me to come to work the next day, I can guarantee you that all drivers will call their bosses that when I say, Madam, you are very stupid. I'm not coming to work again. Forget about me. Why? Oga has 50 million in his account. So because of that, productivity of that economy will drop. So you can see that a lot of things come into why federal government through the CBN does what it does. And one of the things that I think got us into where we are right now, where our currency is not so powerful and all of that, is because of the last administration. They did a lot of printing money, just kept printing money and all of those things, and it resulted in inflation that they couldn't control. So primary market, secondary market. When the government wants to borrow money, they do it through infrastructure. First one is through the primary market. They can come to you directly and say, come and buy this instrument directly from us. Example, Treasury Bill. And I'm going to show us how Treasury Bill works at the primary market. But let me not get ahead of myself. I'm just going to take it one step after the other. Then secondary market is a market where existing securities are bought and sold. So now, if you have bought, just like that analogy that I gave of a dealer or a distributor of Coca-Cola, after that distributor has bought like maybe 2 or 3 tippers or trailers of Coca-Cola, he or she brings it to our own warehouse or store and start to sell from there. So that's like an example of secondary market. An already issued product is now being retailed in that space. And you also notice that to be a distributor of like Coca-Cola or Nigerian breweries, Guinness, all those big guys, why is everybody not a distributor? Because there is threshold. They may tell you that if you don't have up to 500 million trading capital, you cannot be a distributor. So that creates barrier to entry into that space, right? So I'll also show you how barriers is placed for investors to either choose primary market or secondary market. So in this market, participants include government, corporations, institutional investors, and individuals. So let's go to how government borrow through the capital market. They issue what is called a promissory note. All investments that government or corporate or institutions issue, if you think about it, they are more like promissory notes. What's a promissory note? Is to say that this thing, give me this thing, I give you this note to promise that at so date, I'll return. This is a book, How to Make Money on the Stock Exchange, a book I'm reading. So if you come to me and say, oh, Jay, I like this, are you done reading it? Can I borrow the book? And I say, fine, you can borrow it, take the book. These are the conditions, return it on so date. And when you're returning it, I don't want to see my book. I don't want to see any mark. I don't want to see any, and all of those things. But what if I now say that as you're borrowing this book from me, it comes as a charge. I'm charging you for taking it away from me. So when you're bringing it back, you're bringing so much. You're bringing A, B, C. You're bringing X naira as your rental fee for it. In the same way, when government issue promissory note, they collect the money from you and promise you an interest for using your money. And at the end of that contract, they return your money to you, sometimes with the interest, or you may have collected the interest in advance, depending on the structure of that investment. So when they borrow money, how do they pay back? That's another very important question. They pay back through tax revenues, right? The money that they make from revenue, from tax, is what they use to pay back the loan. And generally, all over the world, government is one of the strongest in terms of borrower that people borrower with integrity. Let me put it like that, for the lack of a better word. The body that everybody wants to lend to. There's this conversation in Nigeria right now that I heard on Wednesday when I went for the World Bank Development Update. So World Bank does this program every year in Nigeria where they do like how has the economy grown in the last 1 year. And I think I sent that development update to the group. So please read it. It's something that will help you to just understand what is happening in the country, especially for those of you that are out of the country and you want to stay in touch to know what is really happening outside what Instablog and all of those blogs are not places for news, for you to know what is happening. What those ones do, what they do really is to just do clickbaits. They just find one headline that can trend, they can get a lot of reaction, and that's what they post. If you want to really know what is happening, you have to look at all these reports and read them, right? So in that development update, they shared what is happening in the country and all of those. And one of the conversations that came up is the fact that banks right now, someone posed that question to the CPN governor, that banks these days don't want to lend to businesses. They would rather lend to the government through instruments like this. They will invest the money into bonds, Treasury Bills, than lend to people. What is the government doing about that? And if you think about it, banks are also being safe. They are trying to play safe with depositors' money. Because now, if it is you have 1 million in your account. That's all the money that you have. And that money is not your own. Someone gave you that money to keep. And you know that person is going to come back, except the person dies. Person will come back for his or her money. So, and you also want to invest that money in such a way, or you want to use that money for something that like to give you some return before the person comes back. What are you going to do? You're going to look for a safe place to put the money. So that's a conversation for another time. A lot of banks will rather lend to the government because the government, everybody knows government instruments is the safest all over the world. It's not just in Nigeria, all over the world. So people rather lend to the government. Why? What's the rationale behind it? First off, government cannot declare bankruptcy. If you lend someone money and the person declares bankruptcy, there's nothing you can do. Your money has gone. Government cannot declare bankruptcy. They know that government will continue. When you lend your money to government, it's not Tinubu you are lending into. You are lending to the government of Nigeria. Anyone who assumes the position of the president owes you and is going to pay your money. So that's the way it works, right? They also know that worst case, government will increase taxes because if they don't have money to pay back the loan that they have taken through bonds or treasury bill, they can raise the taxes so they can get more money. And that's what Nigeria is currently doing. From next year, they are broadening the tax net. A lot of conversations around it, and people are. My own analysis of the new tax law is actually that it is better than what we currently have. It is more advantageous because we're now moving towards a progressive tax system. What does that mean? It means that a tax system that takes more from the rich folks and sort of exempts the people that don't earn a lot of money. So for people that earn less than 800K right now in Nigeria, they're not going to pay any tax. If your business is making less than 100 million in revenue per annum, they're not going to pay any tax. Before, it was 50 million. Now, it's 100 million. That's the threshold. So a lot of things are happening in that space. The conversation That's also happening online for people who are remote workers. You work in the US, you work for a US company, but you live in Nigeria. You're going to pay tax in Nigeria. And people think that, how would they find out? You don't know that it is so, except the money is paid to you through Bitcoin. If it's paid to you through normal currency, they will track it down, because that's why you have BVN. They can use your BVN. There are infrastructure right now that the Nigerian government has to know how much actually enters your account on a monthly basis. And if you're not declaring tax, they'll just watch you. Maybe they watch you for like 1 year. They see that you're not coming to pay any tax, and they are seeing the inflows and outflows from your account. Then they'll be forced to issue you what they think is fair. So, and it will now be what they think is fair plus penalties. So it's better for people like me who earn a lot of money remotely to just go and render our return and just go to the tax authority and say, for this month, this is what I have made. What is my tax? And they charge you, you pay it. They look at allowable expenses. What are the non-allowable expenses? You pay the tax gentlemanly. Or you elope or you escape the tax, you don't pay it, and you allow them come to ask by themselves. Once they come to ask, there's an element of fine. When you see things where people just say, they just brought a tax bill of 30 million for me. How much did I make? If you had gone to them before they came to you, that person would have been like 5 million or 10 million, because once they come to you, you let them use their discretion. So imagine that, okay, if this volume of money entered your account in the month, it's all for you. What if the money is not for you? What if some money is for somebody? What if the money is meant for something else? Your company has told you to do something with the money and they just paid it into your account. So all of those things need to be corrected. So governments can either increase tax to pay their loans or get more money. And for sometimes, within the Nigerian context as well, government also do not just increase tax arbitrarily. Why? Because if you increase, there's a political undertone to it. You can't just increase tax, keep increasing tax. People will remind you during election time that you made life difficult for us. When we talk about, this is more, let me get a bit more spiritual. When we talk about Solomon is the richest king that ever lived. Did you know that Solomon actually was a taskmaster? Sorry. One of the things they blamed him for in his country is that he taxed them heavily. Solomon got accountants to tax people. Like maybe if David was charging them 10%, Solomon charged them like 50%. That's why he made most of his money he made a lot of money for his country from taxing people, right? So tax has always been a thing, right? So you can do that. So government sometimes don't want to increase the tax because of political reasons. They know that if we come to these people to vote for us in another 4 years, they will refer to the fact that we increase their tax and all of that. So how can we manage that? So they go for debt instruments instead. Example, the US Treasury or Nigerian government issues bonds regularly to finance federal spending with buyers ranging from domestic. Let me move away from that. So when you think about fixed income instruments or investment generally, investment will fall into two buckets. We have fixed and variable income securities. Fixed are those from the word fixed. It means it is predictable. You know what you will get from it, right? Over a certain period. Variable are those ones that you cannot really tell. It is the forces of demand and supply that would regulate it. For instance, if you buy shares right now, you cannot really tell with certainty how much you're going to make from it, right? The forces of demand and supply just come to play, and then it takes you to where you don't want to go sometimes. So the word that differentiates fixed income from variable income is predictability. You can predict what you will get from fixed income. You cannot predict from variable income. So these are some examples which I'm going to now talk about in detail. First one is mutual fund. You probably heard this mutual fund a lot of times. One of the investment that is most talked about, this and stocks. They are the investment that are most talked about. Mutual fund. From the word mutual means when you cooperative, that's what it is, or a pool. It's a pool of funds from different investors into a particular bucket. Within mutual fund, there's something called underlying assets. Underlying assets is what that mutual fund invests into. So for you to know whether a mutual fund is high risk, medium risk, low risk, you need to think about or ask questions on what does this fund invest into. Let me give you an example. One of us on this call, I don't know whether she's there, she's my friend, Dr. Sarah. She has a platform where people can invest into our platform and get a certain percent at the end of the month. So if you see that kind of opportunity, the question you should be asking is, first off, what is the underlying asset? So if you're going to give me 48% or 50% return, what are you investing the money into? That is what will tell you, is this high risk? Is this medium risk? Is it low risk? So the ones that invest into things like Treasury Bills, don't forget I said government is the most reliable or the most stable borrower in the world. People rather just give money to government because they know that bad as the bad, these guys will pay back, right? Worst case scenario for government is they will print more money and use the money to pay the debt. Another worst case, they can't print money because of inflation. They will go and borrow more money to pay the debt. Now, you will see that in government finance or public finance, there are a lot of things that a lot of gray areas that you cannot adopt to your personal finance. Personal finance is divided into three, which I started with just personal finance in my journey, but now I talk more on a broader level. I cover the three aspects. The first one is personal finance. I talked about you and I. The second is corporate or business finance, which is for the corporate world, small scale business owners. And the third is public finance, which is more tilted towards government funding and government finance, right? So I talk on those three levels right now. What I saw, the more I study, the more I practice these things, I see that there are a lot of principles within public finance that you dare not apply to personal finance. You're going to get it wrong. Example, government can borrow more money to pay outstanding debt. If you do that in your personal finance and you're not very careful, you can find yourself in a cycle of debt that never ends. It's called debt spiral. It just spirals and it doesn't end, right? So you have to be very careful on the adoption of some principles. You know that, oh, is this a personal finance principle? Is it a corporate finance principle? Or is it a public finance principle? And just balance things out, right? So mutual funds, I'm talking about mutual funds, and I said you need to understand that what makes a mutual fund, what tells you the level of risk involved in a mutual fund is the underlying asset, what that mutual fund is investing into. Mutual fund is a means to an end. It invests into something. What are the things that it can invest into? Just on your screen, you can see bonds, commodities, stocks, ETFs. It can invest into REITs, real estate investment trusts, and maybe it can even invest into normal funds, right? So let's go on. These are the types of mutual funds that you can think about. And again, the type of mutual fund is also a description of the underlying assets. What it invests into is what tells you the types of mutual fund. The first one is equity fund, which we discussed extensively in our class on equity. Sorry, excuse me, guys. Which we discussed extensively during our stocks class. Equity fund. What is equity fund? It's a mutual fund that invests into stocks of different companies. So my equity funds right now with Cardinal Stone Partners, when I checked it, let me show you guys. When I checked it, I need to escape this first. Hope I can do that without canceling. Okay. trying to show you guys the cardinal stone. And by now, I hope you guys have opened the account. If you are still having difficulties opening accounts, you should please reach out and let me guide you on what to do. So this is my cardinal stone account, right? And by the way, I would also share a principle with you that I posted just today on social media. I want to give you the breakdown so that you just understand how it works on a one-on-one level. So this is my cardinal stone account. Asset management. Okay, I want to show you guys equity fund. So when I invested in this equity fund, I invested 250,000 naira because I just wanted to test how it works. Then I think it was earlier last year, mid of last year or early last year. Okay, you can see the current yield. Current yield of my equity fund is 38%, right? I invested 250 is now 407,000 naira, 38%. How does equity fund works? How does it work? I just put the 250,000 in this bucket. I don't know what they invest into. I just understand that it is stocks. It's 100%. Some of them will tell you, you will see the fact sheet. Every investment will have a fact sheet. The fact sheet will tell you the details of that investment, what that investment is investing into. If I can use that, permit me to use that tautology, what that investment is investing into, right? So that's what we'll tell you. Some of them will tell you this equity fund would invest 70% of its proceeds into stocks and 30% into fixed income instruments. So when they say it invests into stocks, you don't know, I do not know the company stocks that this is invested into. That is not my business. My business is that I say, Cardinal Stone Partners, I trust you guys. You guys are professionals at what you do. Take this 250K and invest it in stocks the way you want it to be invested. So they do the investment, they manage it, and all of that. That's how come it is this. The other approach to stock broking is, I have the two, is to buy individual stocks myself, which is what you can see here. In these individual stocks, I put 14 million in individual stocks of different companies. The total value of my investment in that bucket is 22 million, right? I've gotten a return of 8 million. ROI is 55.22%. So this is the stocks I bought by myself. I'm getting 52%, 55%. The one Cardinal Stone bought that I don't know the stocks that they bought, I'm getting 38%. Someone will say, why not go buy all the stocks by yourself? Do you know why I have 52.22%? Because I have the knowledge of stocks to buy, what to check, the industries to buy, and all of those things. That is one level. The other level that I believe is a bit more advanced that I do, I always say that this is, if you think about all this money in this stocks account, this is like 20% of my stock portfolio. The other 80%, I don't have app for it like this. I just select a fund manager, I give them the fund, quite a substantial amount of money, and they buy the stocks and manage that for me. That as well, I don't know the stocks that they bought. It is called, so when you are dealing with stockbrokers, you can take one of these two paths. The first one is discretionary management. The second is non-discretionary management. From the word, they're just English words. Discretionary means that I am giving you the authority as the owner of the funds, which is what I did in that other one. I'm giving you, why I did this one. This account is simply for training purposes, so that when I'm training people, I can show them live demonstration of how these things work. But this is not my real investment. My real investment is done through discretionary assets management. So I identify a good stockbroker that I currently use, Codros, and I just tell them that I have this 100 million. Take this 100 million and invest it in stocks for me. We set some conditions, terms and conditions. and I just allow them manage it. So that kind of arrangement is called discretionary. The word, use your discretion to buy the stocks. Manage the portfolio for me. Just send me statement of account at the end of every quarter. The other one, which a lot of people use, in fact, 99% of Nigerians use, is non-discretionary, meaning that the broker just provides you a platform, right? And you just trade, which is what I'm doing right now. You just buy the stocks by yourself. You have the burden of going to learn how it works. When you've learned it, you now start applying the knowledge into buying and managing your own stock portfolio by yourself. 99% of Nigerians do this because for you to do discretionary, you need like 100. Some brokers will tell you 100 million minimum, 100 million to be able to for them to be able to manage that portfolio for you. So it's really for people that can afford it, right? But this is a good place to start. I just wanted to show you guys the equity fund just to drive home the points I was trying to make. Let me project my slide and continue. That's equity fund. The next type is fixed income funds, which is also called bond funds, and it's quite straightforward. It invests into government securities. The next one is money market fund, which is, I think, is the most popular type of mutual fund. It invests in short-term debt. When you hear investment terms like this, don't overthink it. It's simple English. Money market. It is a place where money is bought and sold. They buy money. That's the meaning. That's what it means. But to help you understand it better, what actually happens in a money market is banks and big corporates, they come here to borrow money for short-term liabilities, meaning that a bank can say that I need to pay my staff salaries for this month. Today is the 11th of October. My salary is going to be due by the 15th of October. I've looked at my books. I don't have the money to pay all the salaries, and I can't afford a scandal right now. For the say, X bank is not paying salaries on time, and people. So they go to a money market and borrow the money. Who are the players in this market? The asset management companies. They are the players, essentially the players in this market. So people come and borrow money from them. When they borrow the money from them, they charge them, just like you borrow money from banks. Banks also go and borrow money from the money market. That's the simple explanation. The next one is balance or hybrid funds. From the word balance or hybrid, it means it's a combination of two things. So, and when you also think about it, when you say it's a combination of medium risk and low risk investment, so stocks and bonds. A balanced fund would invest into, say, like 50% of his proceeds into stocks, another 50% into bonds. That's why it's called balanced, right? And the last one is the index fund, which essentially tracks specific market index. So what are the benefits of investing in mutual fund? Diversification. I need to move fast now. Experts make investment decisions for you. Funds cater to different risk levels and financial goals. Even smaller investors can create wealth with small investments. So it's really the very, very good investment you can start with as low as 5,000. Low cost investment, the power of compounding. That compound interest also comes into play when you invest into this. The next one is bond. I sort of already explained how bond works. It is you giving money, lending your money to the government for a long term, starting from 1 year and above. Bond can go up to 10 years. But for Nigeria, we don't do up to 10 years bond. I've not seen 10 years bond in a while because I'm not sure our what's it called, is that strong. I'm not sure anyone will want to comfortably just lend Nigerian money for 10 years. So 5 years, people can still do 5 years. So the common one you will see is 1 year, 2 years, 3 years, because really think about it, before any change in government, it's like 4 years. So people want to be safe. It's just a risk management strategy on people's parts as well. Okay, these are just types of bonds. We have corporate bonds, federal government bonds, state government bonds, and euro bond. For those of you that are interested in foreign currency denominated investments, euro bond is your go-to, right? For you to invest in euro bonds, you need a minimum of $200,000 to invest in it at the primary market. But from the secondary market, you can invest as low as $1,000 into euro bond. Euro bond simply means that it's a bond, it's a Nigerian government-owned bond that trades in Europe, right? It trades in Europe, or it is a Nigerian government bond. So I also try to differentiate between bills and bonds. Those are two words that you may hear interchangeably. Bills is treasury bill, right? It is usually for investments that is less than a year, while bonds is usually 1 year to 10 years. Let's talk about T-bills. T-bill is one of the very interesting investments that pays you your interest in advance. It is issued in discounts. I gave this analogy a while back that when normal people want to buy things, let's say you want to buy a car today, and the cost of that car is 10 million to Kumbo car. I'm not sure you can see any brand new car for 10 million now. You want to buy the Kumbo car for 10 million, and you have 100 million in your account. What a normal average person would do is he will just go to his bank account and make a transfer of 10 million to the seller of that car. What will someone that is knowledgeable, a financially intelligent person do? Like me, I've done it before. I look for investment. I look for investment that can pay me that amount that I need as interest. T-bills is always my go-to. So example, I wanted to buy a car, then the car was around that 10 million. So I just look for a T-bill that can pay me 17%. So I have the capital. I put my 100 million capital in it, and I got 17%, 17 million in advance. So I can use that money to do what I want to do. And at the end of the investment, I go back and take my capital. So it's more like I ate my cake at the beginning and I still add it at the end. When you say you cannot eat your cake and have it, no, you can eat your cake and have it in investments, if you understand how it works. So Treasury bill pays you interest in advance, and then you get the principal back at the expiration of the investment. So I just described how it works, which I already explained. And the next one is commercial paper. Commercial paper functions more like Treasury bill, but it is used by private corporations. So bonds and T-bills are used by government. Commercial paper, corporate bonds are used by private entities or companies that are listed on the stock exchange. One of the catch for commercial paper, I don't know whether it was one of you who had seen that I saw a commercial paper, how safe are they? No, it wasn't you guys, it was another class. How safe are commercial paper? And I said commercial paper can be a low risk investment, and it can also be a medium risk investment. Why? Because of the entity that is involved. Commercial paper of which company are you buying? If you're buying a commercial paper of Dangote PLC quickly needs money and he wants to cover a time-sensitive liability. You now raise commercial paper. Well, Dangote is a big company. The credit history of Dangote, or credit report of Dangote, or credit rating is quite high. So I don't mind. But if another company like a Sheyi Corporation, I like using that just to be safe, so at least I'm using my own name. So if a Sheyi Corporation is selling commercial paper, you need to be careful of that kind of offering. Why? Because if the company is unable to pay back, commercial paper are largely unsecured. They are unsecured investments, meaning that there is no collateral. They're just giving your money to the company based on a promise to pay you a certain interest. So if anything happens to the company before the expiration of that arrangement, example, I know I saw Sujimoto's commercial paper a while back. I honestly don't know. Someone sent to me and asked me for my opinion. And for things like that, you also have to be careful because you don't want to demarket anybody, right? So I don't now know whether the person invested or not. And now, because of what has happened over time to him, EFCC case and all of those things, I don't know whether they've been able to pay back that commercial paper. Let's assume that they are unable to pay back and the company becomes insolvent. you have lost your money. So when you want to pick commercial paper, you have to be, your major priority is to look at the strength of the company, not the interest. And another thing is, you need to also know that companies that give higher, the higher the interest the company is giving on commercial paper, the lower the strength of the company. To help you understand that, let me give you this analogy as well. Nigeria, most of Nigerian investments pays higher interest than most of the investment that you find abroad. UK, US, Canada, all these big countries. Nigeria, it's better to invest in Nigeria than in all these big countries in terms of interest payments. I'm not talking about any other thing, because of high interest. So now wonder, because when you think about it, you're an investor. I'm giving you two countries to invest into, and let's say Nigeria. Let me even ask you guys. I want to hear you guys type. I want to read from you. Let's say that Nigeria gives you 10% on an investment, bond investment, and UK is giving you 10% on bond investment as well. Which country are you likely to choose? Let me hear you guys. Just type it out. Which country are you likely to choose? I'm waiting. Are you guys listening? Or am I talking to myself?
Can you come again, please?
So I said, Nigeria is giving you want to invest in bonds. The bond promises you 10% interest. UK is giving you 10% interest. Nigeria is giving you 10% interest. Which one are you likely to choose? You see? So it's just a no-brainer, because UK economy is a bit more stable than the Nigerian economy. So to make Nigeria attractive, to make people want to choose Nigeria over the UK, that is why the interest is high. So that as an incentive to say that, okay, you won't choose us. Let's raise our interest. But when you know that UK is giving me 10%, Nigeria is giving me 30%, I'm an investor, I'm looking for the best return possible. I will choose Nigeria in that instance. Right. So the higher you see that a company is willing to give, it means that the credit history or the capacity of that country to raise money is still low. The bigger a country becomes, or a company becomes, the more alcohol is bright, that it starts to exhibit, keep your money. You see, there was a bank like that in Nigeria that they called I think this was way back in the year, maybe like some 10 years ago. They called some of their retail customers with 10,000, 5,000, say, come and collect your money. We want to close your account because we want to go into institutional banking. We want to only face big companies and HNIs, people that have money. We don't want all these the 10,000 naira customers are the ones that make the loudest noise. We don't want you guys. Come and take your money when big boy is talking. Yeah. So when you see a commercial paper, the long and short of my story is, when you see commercial paper, you have to be wary. Don't just be fixated on interest that it is paying. You have to think about the security of your principal as well. Yeah. I think one more and then we're done. Okay, let's give it a The last one is certificate of deposit, which is also like fixed deposit. Depends on where you are looking at it from. Some countries will call it fixed deposit. Some countries will call it certificate of deposit, which is simply you get an investment with a bank, you put your money for a fixed period of time, they give you an interest for that, which is usually higher than whether you're keeping in normal savings account. They give you an interest as an incentive to enable you to keep the money. And at the end of the period, you can take back your money plus the interest. Yeah, I won't go into it here today. So that is the end of this class. So I would allow you guys to ask questions if there's anything that you want me to clarify based on what I've shared or based on what you listen to in the recording. You can please raise your hand if you have questions. And if you would rather just type it, you can type it out. I would look at it. My company is currently negotiating a loan with a bank. We want a tenure of 4 years. We will not give more than 2 years, even though it's an asset finance. Happens but and more juicy. Yes, it's true. That's what it came up at the World Bank Forum just on Wednesday. Yeah, it's a thing in Nigeria right now. Banks are, but CBN can also force them. because think about it. It's not CBN's money. Yeah, they can make all those quota system and all of those things. The percentage that you must lend to